So in this morning's U.S. Bank Economic 360, we've talked about some unsettling topics in recent weeks. High unemployment in the U.S., the recession in Europe, just to name a couple. Yet the U.S. and some European stock markets are up over 10% this year. So how do you explain that? Well, we bring in U.S. Bank's Jim Russell. Good to see you again, Jim.
Good morning.
So all the indicators are not so good. How has the market stayed so strong through this?
It's a common question, Brian, and it's one we have to walk through clients quite often, and that is, the news is so bad or even mediocre at best, how can the markets be up? In fact, we have a little bit of an illustration that I'd like to walk through. What we can see here is the S&P 500 really over the last year or two. Year to date, the S&P 500 is up 11%. So in light of some of the things that you'd mentioned, high unemployment, low job growth, very stagnant growth here in the United States, despite the fact those are indeed in place, the markets are up. Let's take a look at Europe. I think perhaps the bad news is maybe even more distinct there. The stock market in Europe is up about 9% year to date. And so how can that be? What we classically how we describe that is that the markets are climbing a classic wall of worry.
Wall of worry. That's an interesting picture word. What do you mean by that?
What that is classically when there are very visible and evident problems in the economy, the markets always look forward and discount or incorporate or digest those in the market prices almost immediately. Many of the issues that you brought up, high unemployment, low growth, the fiscal cliff, European problems have been really in place for some time. The market participants have had a chance to digest those. They've taken market prices lower. In fact, we entered 2012 at very low valuations on the stock market. Because these problems do appear that they're not getting much worse, maybe not much better, but not worse, and there may be solutions on the horizon, namely the Federal Reserve here in the United States and the European Central Bank in Europe, it does appear that these issues may be solvable. Given that's the fact, the markets move up a bit.
But this wall of worry, you wonder where they reach the top and fall off the other side.
Understood.
What do you think that this bodes for the future, the period ahead?
Yeah, the markets are always forward-looking, as you imply. Yeah. In fact, the markets look about 6 to 9 months into the future. And so the markets are reacting to two things. Number one, day-to-day business news and developments, especially out of Europe, the presidential election, etc. But the markets, more importantly, are also starting to peer into the spring of 2013. What we see for that period, frankly, is a little bit more of the same. Very slow economic growth in the United States, probably unemployment right around the 8% range. Certainly we do not know who the next president of the United States is going to be. Europe remains in a recession. Low interest rates also the key.
As a market analyst for U.S. Bank, where do you sit on that wall of worry?
We do think that the stocks are inexpensive, but we do think that they've run a long way, as some of the charts would indicate. We do think the market's probably due for a little bit of a breather, and then we'll have to re-examine in the fall. We are hopeful, frankly, fiscal cliff gets solved, Federal Reserve is going to be active, things settle down in Europe just a little bit.
Very interesting picture. We really appreciate your analysis, Tim.
Thank you, sir.
And we appreciate U.S. Bank.